Okay, here's a question for you. Can a company growing revenue, like 26% year over year, in this massive AI and cloud data market, still be, maybe not a great investment?
It sounds a bit strange, doesn't it? But that's exactly the puzzle our source material puts in front of us today with Snowflake.
Welcome to the deep dive. This is where we take your sources, articles, notes, research you've gathered, and really try to cut through all the noise.
Yeah, we want to pull out those critical insights, the key facts, maybe even the surprising details you might have missed.
Our mission is basically to get you a shortcut to being genuinely well-informed on the topics you care about.
Exactly, helping you understand what really matters in all that information.
So today, we're doing a deep dive requested by one of our listeners. We're focusing on Snowflake Inc., ticker SNOW.
And we're looking at it specifically through a value investing lens, using a pretty comprehensive research analysis report from early June 2025.
Right, so this report gives us a solid base looking at the company, data, the analytics, and how it lines up, or maybe doesn't line up, with a value framework.
It's a good starting point for this kind of analysis.
And hey, before we really jump in, make sure you're following the deep dive wherever you get your podcasts. Subscribe, maybe leave us a review if you like what we do.
Definitely helps us out. And a quick reminder for Stock Analytics AI members.
Oh yeah, if you're subscribed at the Euro 4.99 a month tier, you can actually give us a ticker symbol.
And we'll prioritize doing a deep dive on that company for you. It's a neat perk.
So stick with us today. We're going to unpack Snowflake's tech, its financial picture, and there are some pretty interesting numbers behind the headlines there.
Yeah, especially the difference between GAAP and non-GAAP.
Exactly. And we'll explore why, despite all the growth and AI buzz, our source material is actually quite cautious about the stock price right now.
We'll get to the key takeaway, what the analysis recommends for someone thinking like a value investor.
Okay, let's start at the beginning then. What exactly is Snowflake? What do they do?
Okay, so at its heart, Snowflake provides this cloud-native data platform. They brand it as the AI Data Cloud.
AI Data Cloud?
Okay. Yeah, think of it like a super scalable service built specifically for the cloud to handle storing, processing, analyzing just massive amounts of data.
So not like older systems just moved to the cloud.
Exactly. They emphasize this novel architecture designed for the cloud from day one. That's kind of their key differentiator technologically.
And how do they make money? What's the business model?
It's primarily consumption-based, so you, the customer, pay for the compute resources you use. They measure this in Snowflake credits.
All right.
And you pay for the data you store. It's flexible, which customers like, but it also means their costs can fluctuate.
Right. Any other revenue streams?
Yep. They also make money from professional services, helping customers set things up. There's the Snowflake Marketplace, where data and apps are shared, tools for developers like Snowpark, and various partnerships.
Got it. You mentioned the architecture.
Yeah, the source points out it's decoupled. Storage, compute, which they call virtual warehouses, and the cloud services managing it all are separate layers.
And that lets them scale independently.
Exactly. That's key to their pitch on elasticity and, potential cost efficiency.
What about specific products? The source mentioned a few.
Right. Beyond the core platform, there's the marketplace, which apparently has over 3,000 data and app products now.
Wow.
There's Snowpark, letting developers use languages like Python right inside Snowflake, and Cortex AI, which is their managed service for building AI and machine learning apps supposedly easier, even using SQL.
So really leaning into the AI and developer side.
Oh, absolutely. The numbers show it as of Q1 FY26, something like 5,200 accounts were using their AML tools every week.
Okay.
They also have things like SnowGrid for managing across different clouds, Unistore for mixing transactional and analytical data, and they're supporting open formats like Apache Iceberg now, too.
So why does a company pick Snowflake over, say, just using Amazon's Redshift or Microsoft's Synapse? What's the main pitch?
Well, the core value proposition is being this single managed platform that works across the big clouds, AWS, Azure, GCP.
Okay, multi-cloud is a big part of it.
Yeah, and they push scalability, performance, ease of use, data sharing without copying data everywhere, and strong security. The idea is to break down those data silos.
Make it easier to actually use the data for analytics and AI.
Precisely. Which leads us to a really critical question for value investors. Does Snowflake actually have a durable competitive advantage? A moat.
Ah, the moat question. Classic value investing. What does the source say? Is there one?
Well, the source identifies potential sources, things like brand recognition, maybe some emerging network effects from that data marketplace.
Like more people using it makes it more valuable.
Kind of, yeah. And high switching costs.
Yeah.
If you've moved massive amounts of data into Snowflake, migrating out is a huge pain.
Right. Rewriting code, retraining people, potential business disruption. Sounds expensive and risky.
Definitely. But, and this is a big but, according to the analysis, Morningstar currently gives Snowflake a no-moat rating.
No moat.
Really?
Even with those switching costs and all that growth.
Yeah.
How did that work?
The reasoning cited is fierce competition. The source suggests that maybe the current stickiness, it's less about an unassailable tech advantage or networked effect.
And more just about the hassle factor of leaving right now.
Exactly. It might be more about the difficulty and cost of migration today, rather than something competitors absolutely can't overcome or match down the line.
So the worry is maybe a competitor comes along with a cheaper option or an easier migration tool in the future.
That seems to be the concern highlighted. And interestingly, even Snowflake embracing open formats like Iceberg, while great for customers worried about vendor lock-in,
could actually make it easier to leave eventually.
Paradoxically, yes. It might lower those switching costs over the long term.
Huh. That's a really crucial distinction, isn't it? Is it a real moat or just temporary customer inertia?
It really is, and the competition just underscores that uncertainty. The market's huge and growing, sure, but you have AWS, Azure, GCP giants with massive resources and customer bases.
Right. Redshift, Synapse, BigQuery.
Plus specialists like Databricks who are super strong in AI and ML. Even Oracle is still in the mix. It's a crowded field.
So wrapping up this section, what's your main takeaway on the business itself?
Well, the basic idea of cloud data warehousing, analytics, AI, it's understandable. The tech is complex, but the function is clear.
But that moat question looms large.
It really does. That no moat rating from Morningstar. From a value perspective, that's a significant flag. It suggests the current strong position might not be as secure long-term as the growth might imply. The durable advantage is still very much up for debate.
Okay, let's pivot to management. Who's running the show over at Snowflake?
The CEO now is Sridhar Ramaswamy. He took over from Frank Slootman, who's moved to chairman.
Ramaswamy. What's his background?
Deep AI and data experience. He co-founded Neeva, a search company Snowflake actually acquired. Before that, he spent like 15 years at Google.
Google, doing what?
He led their entire advertising business, grew it from something like $1.5 billion to over $100 billion in revenue.
Wow, okay. That's serious scale experience. What's his focus now at Snowflake?
It seems very AI-centric, based on the source. Integrating AI everywhere, making the products work better together, operational rigor, being, customer-obsessed.
Making AI easy for businesses.
Yeah, accessible and reliable. He's quoted saying things like, the core business is very strong, product delivery remains on overdrive, and extending value across the whole data lifecycle.
And Frank Slootman is still there as chairman.
Yep. He brings that track record of scaling big companies, Snowflake itself, ServiceNow, data domain, known for being very results-driven.
So a blend of deep AI product expertise in the CEO and a proven execution guy as chairman. Anyone else key?
The source mentions Benoit Dageville, co-founder and president of products, one of the original architects. Mike Scarpelli, the CFO, who's an experienced finance leader. And Thierry Cronz, another co-founder and the CTO.
Okay. Seems like a solid technical and leadership foundation. How does management align with shareholders?
Yeah.
Especially from a value perspective.
Now this is where the source gets really interesting and frankly raises some red flags for value investors.
Oh, how so?
It's about executive compensation, specifically stock-based compensation, or SBC. It's huge.
How huge are we talking?
In fiscal year 2025, SBC was $1.5 billion.
Billion, with a B.
Yep. And get this, that was a staggering 43% of their total revenue for the year.
43%. That seems incredibly high.
It is. Now, tech companies argue they need it to attract top talent, right? But from a value investor's viewpoint, it heavily dilutes existing shareholders over time.
Right. More shares outstanding means your slice of the pie gets smaller.
Exactly. And it massively inflates those non-GAAP profit numbers compared to the actual GAAP results, because SBC gets added back in non-GAAP calculations.
So it makes them look more profitable than they really are on an economic basis.
Precisely. For a value investor focused on true owner earnings, SBC is a real cost, period. Either through dilution or because the company might use cash to buy back shares just to offset it.
Okay, that $1.5 billion, 43% of revenue number is definitely sticking with me. What about other capital allocation decisions? R&D, acquisitions.
They invest a ton in R&D. JAP R&D was almost $1.8 billion in FY25. That's 49% of revenue. They also use M&A. like buying Neeva Datavolo for data ingestion.
Didn't they just buy another company?
Yeah, Crunchy Data, an enterprise PostgreSQL provider, about $250 million.
Why Postgres?
Seems strategic. It bolsters their offering for transactional data, where Postgres is really popular, puts them in direct competition with rivals like Databricks, who also bought a Postgres company.
Ah, keeping up with the Joneses, or Databricks in this case.
Sort of, yeah.
Yeah.
It fits Ramaswamy's strategy of covering more of the data lifecycle, tackling a bigger market they estimated at $350 million.
Do they do share buybacks too? You mentioned offsetting dilution.
They do. Repurchased $1.9 billion in FY25, another $491 million in Q1 FY26. They've got over $2 billion more authorized.
Is that good or bad from a value perspective?
Well, the source notes some analysts question it, especially since they took on about $2.3 billion in debt last year.
So maybe funding buybacks with debt, while still unprofitable on a GAAP basis.
That's the concern. And are they buying that stock because it's genuinely undervalued, or just to prop up earnings per share numbers, or offset that massive SBC dilution? At these valuation levels, it's unlikely to be a value buyback.
So summing up management. Seems strategically focused, rational CEO, but shareholder alignment is questionable due to the massive SBC and maybe the rationale behind the buybacks.
That's a fair summary based on the source. Execution on growth has been strong. They adapt and innovate. But the financial impact of SBC and how they allocate capital, particularly the buybacks, needs very careful scrutiny if you're investing based on value principles.
Okay, let's dive into the financials themselves. Follow the money. How's the historical performance looked?
Well, revenue growth has been, incredible historically. But it is decelerating as the company gets bigger, which is natural.
What kind of numbers are we talking?
Think about this. FY21 saw 123% growth. FY22, 105%. Then FY23 was 69%, FY24 down to 36%, and FY25 was 29%.
Okay, so a clear trend of slowing. Even if 29% is still pretty strong, how about the latest quarter?
Q1 of fiscal 26, total revenue was $1.04 billion, up 26% year over year. Product revenue, the core, also up 26%. So still robust growth, absolutely, but those triple-digit days seem long gone.
Right. Now the big one, profitability. Are they actually making money?
Okay, here's the key distinction again. On a GAAP basis, generally accepted accounting principles, the answer is a clear no. They report substantial net losses.
How substantial?
Q1 FY26 GAAP net loss, $430 million. For the full fiscal year 2025, the GAAP net loss was almost $1.3 billion. GAAP operating margins are deep in the red, like negative 43% in Q1.
Oof, okay. But they report positive non-GAAP numbers, right? That's what often gets highlighted.
They do, yes. And this is absolutely crucial for the value analysis. Non-GAAP operating margin was positive 9% in Q1 FY26. Non-GAAP adjusted free cash flow margin was almost 20%.
So how do you get from a huge GAAP loss to a positive non-GAAP profit?
By excluding things. Primarily that massive stock-based compensation we talked about, the $1.5 billion in FY25.
Ah, okay. So the non-GAAP numbers paint a much rosier picture by ignoring SBC.
Exactly. And for a value investor, GAAP is generally seen as the more conservative, more realistic view of true economic profit. SBC isn't free money. It has a real economic cost to shareholders.
So those ongoing GAAP losses are a major, major red flag from a value perspective.
Absolutely. Finding true owner earnings means you have to account for the cost of SBC somehow. The path to sustainable, growing GAAP profitability is a big uncertainty, according to this analysis.
How does the balance sheet look? Do they have cash? Pat.
As of April 2025, they had about $3.9 billion in cash and short-term investments. Total liabilities were $5.7 billion, but that includes $2.3 billion in convertible senior notes. That's debt.
Okay, so more liabilities than cash.
Total liabilities, yes. But importantly, their readily available cash, $3.09, is significantly more than their actual debt, $2.03. That's a positive sign. They can cover their debt obligations comfortably right now.
Got it. What about cash flow? Are they generating cash even if they aren't GAAP profitable?
Yes, operating cash flow, OCF, is positive. It was $228 million in Q1 FY26 and almost $960 million for FY25.
And free cash flow, FCF.
Yeah.
After capital expenditures.
Also positive. Using the source numbers to calculate GAAP FCF, OCF minus CapEx, it was around $183 million in Q1. They report a non-GAAP adjusted FCF figure of $206 million for Q1. So FCF is positive and has been growing.
But I sense another but coming related to SBC.
You guessed it. Just like with net income, those positive OCF and FCF figures get a big boost from adding back non-cash SBC. If you treated SBC as a cash expense, maybe assuming buybacks are necessary to offset it, the FCF picture would look much, much weaker.
Okay, what about returns? Return on invested capital, ROIC. Are they generating value on the money they invest?
Well, on a GAAP basis, because of the net losses, ROIC is currently negative, deeply negative.
Negative ROIC.
Yeah, one source cited puts TTM ROI at negative 16%. Another calculation based on FY25 is worse. Meanwhile, their estimated cost of capital, the WACC, is probably around 10.6%.
So they're destroying value on a GAAP basis right now, spending capital that costs 10% to generate negative returns.
That's what the GAAP numbers imply, yes. Now, this isn't uncommon for high-growth companies investing heavily, but for long-term value creation, you absolutely need a clear, credible path to getting ROIC consistently above that WCC. And based on the GAAP financials in the source, that path isn't obvious yet.
What about customer metrics? Are they still adding customers or existing customers spending more?
Yes, the customer growth looks solid. Total customers approaching 11,600 in Q1. Customers spending over $1 million a year grew 27% year over year to 606. That's pretty good expansion in large accounts.
Okay.
They also reached 754 of the Forbes Global 2000 companies.
And the key metric, net revenue retention, NRR. How much existing customers grow their spending?
NRR was 124% in Q1, which is still very healthy. It means the average existing customer increased their spending by 24% over the year.
Is there a but there too?
Well, it's a slight dip. It was 126% for FY25 and 131% back in FY24.
So still positive expansion, but the rate is slowing a bit.
Exactly. The source notes it's something to monitor. It could be customers tightening belts due to the economy. It could be competition. Could just be the law of large numbers as accounts mature.
But maintaining high NRR is pretty crucial for their model, right?
Absolutely vital. Expanding existing accounts is much cheaper than acquiring new ones, especially with that consumption model. It's key to their path to profitability.
What's the outlook? What guidance did management give?
For Q2 FY26, they're guiding for product revenue growth around 25% and an 8% non-GAAP operating margin.
Yeah, full year.
Full year FY26 forecast is $4.325 billion in product revenue. That's about 25% year-over-year growth. They're aiming for a 75% non-GAAP product gross margin, 8% non-GAAP operating margin, and a 25% non-GAAP adjusted FCF margin.
So projecting continued 25% growth and aiming for those non-GAAP margins. Still excludes SBC, though.
Right, and hitting those targets consistently in this competitive market will definitely be a challenge.
Okay, so summing up the financials. Strong revenue growth, though it's decelerating. Positive cash flow, but heavily boosted by excluding SBC. Persistent, large GAAP losses. Negative ROIC on a GAAP basis. Customer metrics still good, but NRR showing a slight downtrend.
That captures it pretty well. The true earnings potential is still obscured by the SBC treatment. The balance sheet looks okay liquidity-wise, but capital efficiency judged by GAAP ROIC is poor right now. Growth looks sustainable for the near term, but that NRR dip needs watching.
All right, let's shift gears. How does the market see Snowflake? What's the sentiment out there?
Well, based on the source material, analyst sentiment is generally positive. Most seem to have a moderate buy or strong buy consensus rating.
Okay, what about price targets? Where do they think the stock is headed?
The average 12-month target seems to be hovering around $217 to $220.
The stock was trading around $208 recently, right? So that's not a huge upside they're predicting, maybe 4-7%.
Right. It suggests analysts, on average, see it as maybe slightly undervalued, but not dramatically cheap. The range of targets is pretty wide, though. Some see it going down near $150, $180, others up towards $250.
Did the recent earnings change things?
Yeah, after the Q1 FY26 report, several big firms, Goldman, Citi, RBC, reiterated positive ratings. Some nudged targets up. Wedbush specifically pointed to the AI potential as a positive driver.
What are the common themes in what analysts are saying? The pros and cons?
They definitely like the strong growth profile, the positioning in the AI narrative, those improving non-GAAP margins, and solid customer metrics like NRR, even with the slight dip.
But what are the concerns they raise?
Frequently mentioned are the very high valuation and the continuing lack of GAAP profitability, so even the bulls acknowledge the points that would concern a value investor.
Interesting. What about short interest? Are lots of people betting against the stock?
According to the source, short interest was pretty low as of mid-May 2025, around 3% of the float. The days to cover ratio was also low.
meaning it wouldn't take long for shorts to buy back shares if they had to.
Exactly. Generally, low short interest like that suggests most investors aren't actively betting on the price going down significantly. It's usually seen as a positive sentiment signal, or at least not a negative one.
And the options market. Does that tell a similar story?
It's a little more nuanced, actually. The overall put-call ratio based on open interest was below 1, around 0.83 in early June, which typically indicates a slightly bullish lean, more call options open than put options.
Okay.
However, looking at the trading volume on a specific day, June 2nd, the ratio was slightly above 1 at 1.02. That suggests maybe more bearish bets or hedging in the very recent activity.
Huh. So open interest looks a bit bullish, but recent trading volume may be slightly bearish.
Yeah, it's a bit mixed. The options market did anticipate a big price swing around the earnings report, pricing in about a plus $18 move.
So maybe some caution creeping into the trading,
Right.
despite the overall positive analyst ratings.
That's one interpretation the source hints at. Some investors might be using options to hedge long positions or express a bit more caution than the headline rating suggests.
Makes sense. Who actually owns the stock? Is it mostly institutions? Individuals? Insiders?
It's very heavily owned by large institutional investors, pension funds, mutual funds, hedge funds, around 65–66% of the stock.
Big names.
Oh, yeah. Vanguard, BlackRock, Morgan Stanley, JP Morgan, they're all major holders according to the source.
What about insiders? The people running the company, founders, execs?
Insider ownership is reported somewhere between, say, 5% and 10%. Different sources give slightly different numbers.
Are they buying or selling?
It's a mixed picture there, too. The source notes some purchases by directors, and CEO Ramaswamy bought some shares in 2024. But there were also sales more recently, like by the CFO in May 2025.
How do you interpret insider buying and selling?
Well, insider buying is often seen as a positive signal management has confidence. Selling is more complex. People sell for many reasons: diversification, taxes, buying a house.
Right.
But substantial sales, especially by key executives like the CFO, and particularly if they aren't part of a pre-scheduled plan, do warrant closer inspection, especially given the high valuation and lack of GAAP profits.
Okay, so summing up sentiment and ownership. Analysts are generally positive, but wary of valuation and GAAP losses.
Yeah.
Short interest is low. Options show maybe a hint of caution. And it's mostly owned by big institutions with mixed insider activity.
That seems like a fair summary of the source material's points on market perception.
All right, let's talk risk. No investment is risk-free. What are the key things that could go wrong for Snowflake, according to this analysis?
The source lays out several pretty significant ones. Top of the list probably is that intense competition we already touched on.
From the hyperscalers, AWS, Azure, GCP, and Databricks.
Exactly. That could lead to serious price pressure, make it harder to win deals, and ultimately slow down growth more than expected. That's a major business risk.
What about their reliance on that consumption model?
That's another big one. Their revenue really depends on customers not just signing up, but actively increasing their usage over time.
So if the economy slows down or customers get serious about optimizing their cloud spending,
Snowflake's revenue could take a direct hit. Any broad slowdown in IT spending due to macroeconomic factors is a risk for them.
are there execution risks too? Just running the business day to day.
Definitely. Things like successfully developing and integrating new products, all the AI features, folding in acquisitions like crunchy data smoothly. Managing rapid growth itself is hard. Maintaining platform performance, reliability, security.
And finding and keeping the right people.
Absolutely. Hiring and retaining top engineering and sales talent in this market is crucial and expensive.
What about specific financial risks?
The biggest one, echoing our earlier discussion, is the persistent lack of GAAP profitability. Can they actually translate all that revenue growth into sustainable, growing GAAP earnings?
And the high stock-based compensation is tied into that.
Yes, it directly impacts GAAP results and dilutes shareholders. It masks the true underlying profitability, making it harder to assess the real financial health.
And the valuation itself.
Huge risk. The stock price is baking in incredibly high expectations for future growth and profits. There's very little room for error. Any stumble, slower growth, missed targets, competitive setbacks could lead to a really sharp stock price correction. The valuation provides no cushion.
Tech risks. Beyond just competition.
Well, the pace of change is relentless. They have to constantly innovate just to keep up, let alone stay ahead. And cybersecurity is absolutely critical.
Right. There were those incidents in 2024.
Yeah, and while the source says it wasn't a breach of Snowflake's core platform, customer accounts were compromised due to stolen credentials. It highlighted the risks across the whole ecosystem.
Even if it's not directly Snowflake's fault, that kind of thing can damage reputation and trust, right?
For sure. Plus, they rely heavily on the infrastructure of AWS, Azure, and GCP. If those providers have major outages or make significant changes, that impacts Snowflake too.
What about regulatory stuff? Data privacy seems like a big deal in this space.
Oh, absolutely. You've got GDPR in Europe, CCPA in California, HIPAA for healthcare data, new financial regs like DORA. It's a complex, constantly evolving global landscape.
Ensuring compliance sounds costly and complicated.
It is. And non-compliance carries big penalties and reputational damage. Data governance, privacy, data sovereignty, these are major ongoing challenges.
The source also mentioned something about hypothetical U.S. tariffs in 2025. How could that play out?
It's mostly an indirect risk outlined. If tariffs hit IT hardware, the cloud provider's costs might go up, and maybe they pass that along to Snowflake or its customers.
Or businesses hurt by tariffs might cut back on IT spending overall.
Exactly. Or tariffs on software services could affect R&D costs if they outsource development. It's uncertain.
Any potential upside from tariffs?
Well, maybe. The source suggests if tariffs make traditional on-premise hardware much more expensive, it could actually accelerate migration to the cloud, potentially benefiting Snowflake. But the net effect is really hard to predict.
So stepping back, what are the critical risks here? The ones that could seriously impair Snowflake's long-term intrinsic value? What would you say based on the analysis?
I'd point to failure to achieve sustainable GAAP profitability, losing significant ground to competitors like Databricks or the hyperscalers, a major security incident that shakes customer trust, not being able to effectively monetize all the AI investments, and of course a severe macroeconomic downturn hitting cloud spending. Those seem like the big ones.
And how is Snowflake trying to mitigate these?
Well, they're fighting competition with innovation. The AI data cloud acquisitions, supporting multi-cloud gives customers flexibility. They're trying to address profitability through focusing on non-GAAP margins and operational efficiency, though the GAAP issue remains. They're pushing customers towards things like multi-factor authentication, investing in platform security features, getting certifications, trying to create more of a shared responsibility or shared destiny model.
And tariffs.
Their software model and multi-cloud nature offer some buffer, but they're still exposed to the broader economic impacts.
Okay, we've covered a lot of ground. The business, the management, the numbers, market view, the risks. Now let's bring it all together. The crucial question for a value investor. Is Snowflake stock attractive at its current price?
All right, the bottom line. As of early June 2025, when this report was compiled, the stock price was around $208 per share. That gives it a market capitalization of roughly $68.7 billion.
$68.7 billion.
Yeah.
How does that compare to its actual financial results, like sales or cash flow?
That's where the valuation lies. Well, extremely high. The price-to-sales ratio, PS, based on trailing 12-month revenue, is around 18x.
18 times sales. How does that compare to other large tech companies?
It's very high. The source compares it to Microsoft at about 12.7x sales or Amazon at only 3.4x sales.
Okay, significantly richer than those giants. What about cash flow?
If you use their non-GAAP adjusted free cash flow from FY25, the price to FCF multiple is around 73x.
73 times non-GAAP free cash flow.
Yeah. And price to book value is about 28.5x. Again, compare that to Microsoft at 10.6x or Amazon at 7.1x book value.
And since they don't have GAAP profits.
Right. Their GAAP price to earnings ratio isn't meaningful, it's negative. The market is clearly absolutely valuing future potential, future growth, future profits, not what they're earning today.
Does the source attempt to estimate an intrinsic value? What the company might really be worth?
Estimating intrinsic value here is super tricky, given the lack of GAAP profits and high growth. It depends heavily on making assumptions about the distant future.
But did they cite any estimates?
They did. The source quotes Morningstar's fair value estimate for Snowflake, which was $150 per share.
$150, but the stock was trading over $200.
Exactly. $150 compared to a price of, say, 205, 208x.
So the stock price is like 37% higher than Morningstar's estimate of its fair value.
That's right. And a core principle of value investing is demanding a margin of safety, buying significantly below your estimate of intrinsic value, just in case you're wrong.
And here, instead of a discount, there's a hefty premium, according to that estimate.
Precisely. Based on that $150 fair value estimate cited in the source, there's not only zero margin of safety, but the stock appears significantly overvalued from this particular value perspective.
And Morningstar gives it a very high uncertainty rating, too.
They do, which just reinforces the risk level when the valuation is this stretched relative to estimates.
So the current valuation seems way out ahead of the fundamentals.
Extremely stretched, yes. Multiples like 18x sales or 73x non-GAAP FCF imply the market is expecting near-perfect execution, sustained high growth for many years, and that this growth will eventually translate into very strong, durable profitability.
Leaving no room for error.
Virtually none. Any hiccup growth slowing more than expected, competition hitting harder, delays in reaching GAAP profitability could cause a painful derating of the stock. And again, remember that non-GAAP FCF number is inflated by SBC. Adjust for that, and the price to true economic FCF looks even higher.
Okay, let's bring it home. Based on this deep dive, drawing from the source material, what's the overall recommendation from a value investing standpoint?
Well, look, Snowflake is undeniably an impressive tech company. They're a leader in a massive, growing market cloud data AI. Management seems smart, focused, with a clear vision.
Good.
But from a strict value investing perspective, the source highlights several key deterrents. First, the lack of a proven, durable competitive advantage, that no moat rating against really tough competitors.
Okay.
The persistent, significant GAAP net losses, and the real uncertainty about when or even if they'll achieve sustainable, growing GAAP profitability, especially given the SBC levels.
And
the excessively high valuation. Trading at levels that, according to the cited fair value estimate, offer absolutely no margin of safety and suggest significant overvaluation.
So putting all that together, what does it mean for a listener considering Snowflake through this value lens?
Based purely on the source material and a value investing framework, the recommendation is pretty clear-cut. Avoid the stock at its current price. Or at the very least, wait for a significantly better price.
How much better?
You'd need a substantial drop in the stock price just to begin creating an adequate margin of safety. And ideally, you'd also want to see more concrete evidence emerge, evidence of a strengthening competitive moat and a clear, believable trajectory towards sustainable GAAP profitability before considering an investment.
And all the risks we discussed just add to that need for caution at this price point.
Exactly. Competition, execution, macro factors, potential tariff impacts, they all reinforce the need for a deep discount, a margin of safety, which just isn't there right now, according to this analysis.
Well, that was a thorough deep dive into Snowflake. We hope this was valuable for you. If you want to be the best informed person in the room on topics like this, definitely subscribe to the deep dive wherever you listen.
Yeah, and don't forget, if you're a Stock Analytics AI member at that Euro $4.99 a month tier, you can throw tickers at us, and we'll prioritize deep dives on the companies you're most interested in. Check out the Stock Analytics AI YouTube channel, too, for more insights.
Just a quick disclaimer, as always, this analysis was based only on the source material provided to us. It is absolutely not investment advice.
Nope. It's purely for informational and educational purposes. Always do your own research, consider your own situation, and please consult with a qualified financial advisor before making any investment decisions.
And one final note. The source material used for this deep dive may have been prepared with assistance from AI, using publicly available information.
Good point.
So here's a final thought to leave you with. If Snowflake is busy building this AI data cloud for the future, and the market, through that high stock price, seems to be expecting flawless execution and massive future profits, how much of that amazing future is already priced in today?
And how confident can anyone really be about that no-moat rating changing significantly in the next 5 or 10 years given the competition?
Definitely something to chew on. Thanks for tuning in to the deep dive.